Good morning and welcome to this Monday, December 23rd edition of Trading Places Live at earningsbeats.com. I'm Tom Bowley, Chief Market Strategist here at earningsbeats.com, and I'll be your host for the next 30 minutes, featuring everything you need to know as you prepare for the trading day ahead. Just a couple of quick things to get out of the way, a few announcements with the holidays and all coming up. I do want to mention that we have Market Vision 2020 coming up. Registration is open. We are getting closer and closer now to the actual event. It will be held 2 weeks from this past Saturday, so it's less than 2 weeks away now. You can go to earningsbeats.com, and I will show you here how you can navigate this. If you go into earningsbeats.com, at the very top there will be some tabs going across. Click on Market Vision 2020. And you will see the event. You've got the agenda here, keynote speaker. I can't emphasize this enough. John Murphy has decided to join us, which really exciting for me. I'm mostly a self-taught technician, but I was heavily influenced by John Murphy's work, read his books, and his inter-market relationships that he uses, and his work on international markets and so forth is second to none. So if you're looking out into 2020, and I think that's going to be one of the most interesting questions, actually, I'm interested to hear from John on this. But, you know, the S&P 500 has been outperforming a lot of the places around the world, a lot of different financial markets elsewhere. And I'm really curious to get his take on what he sees in terms of international markets going forward. You know, he's mentioned that he thinks they're going to be stronger, but are they going to be stronger than the U.S.? And so that'll be an interesting point of conversation for him during his keynote speech. But then you can see a lot of my friends and colleagues, stock charts, have agreed to join us. We've got just a tremendous lineup of technical analysts. So if you haven't already signed up, I would suggest you go there and do so. Again, it'll be 1 week from this Saturday. So Saturday, January 4th, as we kick off a new year, Market Vision 2020. Really looking forward to that. Make sure you get signed up. Also want to just talk for a minute about our holiday schedule here at Earnings Beats. Things are beginning to slow down. I noticed today, actually, the number of folks listening today is down sharply from what we have had in the past. So I know a lot of folks are beginning their travel plans and their celebrations and so forth. So we're going to do some of that ourselves here at Earnings Beats. So our schedule will be much lighter. This is going to be the last Trading Places show of 2019. So your next Trading Places show will be held on Thursday, January 2nd. That will be at Stock Charts TV. Of course, I do Stock Charts TV Tuesdays and Thursdays from 9 to 9:30. And right here at Earnings Beats, I do Trading Places Live on Mondays and Wednesdays from 9 to 9:30. So the next show will be at Stock Charts TV a week from Thursday. We'll be ushering in the new year. That will be, again, Thursday, January 2nd from 9 to 9:30. So mark your calendars for that. So no more Trading Places Live after today through the end of the year. We're also going to be cutting back a little bit on our services throughout the week. The daily market report, for instance, what I've decided to do, rather than write a blog article over at Trading Places at Stock Charts and then also write daily market reports, is throughout the holidays, I'm just going to write the daily market report over at Stock Charts. So those of you who are not members at Earnings Beats will get a taste of what I do every day in terms of writing these daily market reports. What I will do probably is send out an email to all of our members at Earnings Beats and let them know when I've published the article over at Stock Charts, and I'll probably give you a link so that you can go directly into that article. But that'll be another change. Let's see, the weekly portfolio report that I do every Sunday, I'm going to continue to do. Just sent one of those out yesterday, and I'll do one again this Sunday. I guess that's probably it for the changes. You know, you might see, if you have any questions, if you write into us, you might get a little bit longer response. I think for the most part, we do get back to you very quickly if you have any kind of questions. But we also will be celebrating the holiday, so you might see just a little bit of a delay in terms of response there. All right, let's go ahead and get into today's action. Today's going to be really this whole week and into the early part of next week. Will be a little sluggish in terms of volume. The markets generally are not volatile at all this time of the year. Historically, you tend to see very small moves, but they tend to be higher. And we've already seen some of that here over the past couple of weeks. You can see the Dow Jones has been just kind of this boring, steady push to the upside. Same thing with the S&P 500, really across the board, all the major indices. If you noticed, there was a lot of volume on Friday. Just keep in mind, every 3 months, there's what we call quad witching, just when a lot of different options, futures, contracts all expire simultaneously. It creates a lot of volume. Don't read into it. Don't say, well, wow, we finished off with a high and it was on massive volume, therefore the Dow is going to go down. I would really caution you against that. If you look at a chart, you're going to see the third Friday of every March, June, September, and December. You should see these big spikes. Don't read into it. It's just heavy volume because of the things that are taking place in the market. Looking though at Friday's action, you can see the Dow Jones, S&P, NASDAQ, and the small cap index. All the small cap index was relatively flat on Friday, but they all did move higher. The other thing to point out is the 10-year Treasury yield. It is down a little over 1 basis point this morning, 1.90%, but it has been making a steady move up in December, and that has been coinciding with this push higher in the equity markets. So we're seeing that money rotate away from the defensive treasuries and move into the more aggressive equities. This relationship is a relationship that I watch very closely. And the fact that stocks are moving up in December and throughout the holidays, this is nothing new. And I'm going to talk about that in just a minute. As far as the sectors go, XLV healthcare had a really strong day on, well, I shouldn't say really strong day, up about 0.3%. Technology up 0.25%. These were the two leading sectors, and you can see both. These have been the two strongest areas of the market. Maybe throw financials in there more recently, but outside of financials, these have been the two best performing sectors. And I'll also talk a little bit about healthcare in terms of seasonality in just a minute. Let's see, mobile telecom had a really nice day on Friday. You can see making a breakout, did climb almost 2%. So really good move here to the upside. That was nice. Recreational services, excuse me. Recreational services up 3.7%, making a nice breakout. It hasn't taken out its high for the year, but it does appear to be strengthening, and not just on an absolute basis, but also on a relative basis. And that could bode well through the balance of this year and into next year. Home construction. I know we have seen the 10-year Treasury yield rising. As a result, we have seen home construction moving lower. I believe this could be the start of maybe an ascending triangle, maybe some consolidation, but I think eventually home construction goes higher, mostly because I think we're moving into an environment of moderate growth with fairly low interest rates. Well, more than fairly low. I mean, we're not too far from historically low interest rates, and with inflation low, that is going to keep the Fed from being too hawkish. Now, I do think, just my own personal opinion, I think the dollar could weaken a little bit in 2020. I think that could add a little fuel to some of the areas like commodities and so forth, and that could fuel a little bit of inflation. So I wouldn't be surprised, actually. I've been calling for the Fed to lower. I wouldn't be surprised if their next move in 2020 is actually to raise. But I don't think that would be a bad thing. I think that will be because inflation's returning to normal, and we've got some pretty decent growth. So that's what I would be looking for. All right, let's move on here. 10-year Treasury yield. I just did a line chart here. I was going to annotate this for you just to show you that in addition to having recent highs up in the 1.90 area, if you're only looking at closes, you can see this was a low back in early July. We bounced and then we fell precipitously from 195 all the way back to 145. And now we've worked our way all the way back, and you can see that's been a pretty key area of resistance. So if you see the 10-year Treasury yield break above 195, that is another really good sign for the equity market, because the yield goes up when Treasury prices go down. When Treasury prices go down, there is money available to go somewhere. It's the selling that causes prices to go down. So then you got all these proceeds. Where would you put that money? Well, if the treasury prices are going down and it's because the market is anticipating economic strength, prices go down on treasuries, yields go up. And if the economy is going to improve, that means bottom line profits for corporate America is likely to go higher. So you've got really a shifting of money from treasuries into equities. I'm on record back in July, I think it was, of saying I thought the S&P 500 in 2020 is going to hit 4,000. I'm sticking to that. I think the S&P 500 is going to have a really big year. I think U.S. equities will have a big year. I think global equities are going to have a really big year. And when you think about it, think about all the money over the last 10 years that has poured into these treasuries, whether it's here in the U.S. or around the world. If we get any kind of growth going forward, especially overseas, there's billions and billions of dollars to rotate out of treasuries. So keep that in mind. All right. Let's take a look. We're going to skip earnings. There really wasn't anything in terms of earnings the whole week. Believe me, not doing these shows, you're not going to miss anything on earnings. I don't think there were any earnings coming out of any significance heading into year end. But let's take a look at a couple of companies that were upgraded, downgraded, and initiated. We're going to start with 3M. 3M was upgraded today, and it was upgraded, I think, to a buy. I didn't write that down, but I think it went from neutral to a buy. But anyway, 3M has been in a downtrend. When you look at it on a relative basis, not been a very good performer, but you know, some things will change. Even though you might be in the same bull market, you do have rotation. And so what I would watch with something like 3M is look at the relative strength. It's starting to come off the bottom, but it's got 7-8 month high, relative high right here, just above 0.370. So if we start to see volume coming in and we start to see the stock trade, maybe get up above this July high and trade at multi-month absolute highs, and then also break out the multi-month relative highs, that's when you want to start taking notice of the stock. So I don't like trading them when they're in a downtrend. I'm a momentum trader. I like relative strength. You know, as this was coming down, you can see the relative weakness. We just haven't seen anything really on a relative basis that would suggest that we want to be involved with 3M. But it could be bottoming, and watch the volume. Let's see if the volume continues to be strong. If it starts to take out key areas of resistance here on this downtrend, here's your lower low, here's your reaction high, here's a lower low. If you go back up and take that high out, that would start to paint more of a picture of an uptrend. So keep that in mind. All right, that was really the only upgrade today. I mean, even Wall Street's going on vacation. Not really seeing a whole lot going on. Downgrades, I'll give you a couple here. Penske, PAG. This was downgraded. A lot of volume coming in here, but it hadn't broken down. Looking at it on a relative basis, just set a 52-week relative high. I'm not buying into this downgrade. I actually think that the stock will hold $50 on any selling. So if it does, you know, sell off as a result of today's downgrade, a lot of folks just see a downgrade and sell. I think sometimes downgrades are opportunities to buy. In this case, I think down to $50 would be area that I would consider owning PAG. But if it does move down and close below $50, I'd have to reevaluate. ROK, this is Rockwell Automation. Big move up, huge gap up, came right down to the 20-day moving average, bounced right off of it, testing the high, being downgraded. I think it's an opportunity. Look at the stock. It's one of the best stocks in the industrial machinery space. Industrial machinery just broke out. On a relative basis, industrial machinery versus the S&P 500 just hit an 8-month relative high just a week or two ago. It's a good group and a good stock. So a downgrade, I think it's an opportunity. I think what we have here maybe equal highs. I would look for rising lows and maybe an ascending triangle breakout eventually. So again, downgrade, I think that's an opportunity. IAC, this is Interactive Corp. They were initiated with an outperform by Wedbush with a price target of $295. I think this one's starting to show some pretty good life here. It was downtrending, not really doing much. Looked like maybe off of this downtrend, a little bit of an exhaustive gap. to the downside. That red hollow candle on heavy volume tells me that. And then it recovered pretty nicely. Sideways consolidation. Last 2 days, look at the volume coming in the breakout. So IAC looking much better now. It's in the internet space, and it has been in a downtrend, but that could be reversing here with this increasing volume. Maybe watch up here in this area, see if it can clear this relative strength resistance area. But I think ultimately you're going to want to get this breakout above about 263, 264, see some volume, see more volume continue to come in. And then I think IAC could be in a position to begin to lead the internet space. So this one definitely is turning a corner. I don't know that I would say 295 at this point. Probably got a little bit more consolidation to do, a little work to do with overhead resistance, but not looking too bad. Apple was reiterated by Wedbush as an outperform, and they have raised their price target from 325 to 350. So 350 from roughly 280 at 70 bucks. That's another 25% from here. I love Apple. It's been a great company for a long, long time, but especially 2019 has been. You can see computer hardware doing very well. Apple, a leader in the group, continuing to do well. I'm fine with Apple as long as it continues to show this kind of relative strength. Now, if we start to break down, you got a nice little uptrend. I mean, we can pull back a little bit for a period of time. I think as long as Apple stays above 260, I'm fine with the stock. And it's going to consolidate at some point. It's not going to go up every day, even though it tries. Nike was reiterated with a buy at Pivotal Research. They had their price target raised from 114 to 117. It did make this breakout above the prior high in October near that 97 area. Volume has been picking up on this push to the upside. I will just say this, and I'm going to have this be the lead in to seasonality. Nike loves the end of the year. The last 4 months of the year, if we go back the last 20 years, you can see on a percentage basis, these months tend to go up. And you can also look at it across the board. That's 7.1, 10.2, 12.9% average return over the last 20 years from September to December. You get into January and February, and they're both negative, although February does go up more than it goes down. The average return in January and February is negative. So a lot of this historical strength that we tend to see in the last 4 months of the year tends to go away in January and February. So the 4 months to start the year, nowhere near as strong as the 4 months to end the year. One other chart, and this was another stock that was reiterated with a buy. This is Skechers. And Skechers, also footwear stock. If you look at the last 4 months of the year, add those up, 9%, minus 1.8%. So the last 4 months of the year, if you're going to pick a footwear company, historically, you'd much rather have Nike than Skechers. Look what happens, though, first of the year. I just said Nike really calms down. Skechers, 6.0, 8.2, 4.5, 12.8. Look at the odds of this stock going higher. You've got, what's that, 14.2, 18.7, 31.5%. Skechers has averaged going up January through April over the last 20 years. That's crazy. 31.5% average return January through April. So let's look at that chart. What's going on with Skechers as we get ready to go into January? Well, it's looking pretty good. Volume coming in, breaking the new highs. Last half of the year, mostly sideways, just making a breakout. And look back in 2019 through basically, well, we had a little bit of a dip here in the second half of April, but there's the first 4 months making a move. And then from there on, rest of the year, not really a whole lot. We did have this nice gap up, but now we're making a breakout. So now I look at that seasonal chart, and all of a sudden, technically it looks pretty good. Seasonally, I know it's good. Skechers is one that should be on your radar. All right, seasonally, I want to just point out a couple things here. Let's go into the IWM. And you can see the IWM, this is so typical. You get past the second, get past second week of December into the second half of December, and we just tend to go higher. And it's starting here. You can see it moving up. I know last December was a little bit of a anomaly. We had a rough December, although we did pick up at the end of the year. You can see right after the Christmas holiday, we had a huge rally into the final week of 2018. But typically you get past the 15th. Let me give you some numbers here. So this is the Russell 2000. The IWM is the ETF that tracks the Russell 2000. So the Russell 2000, starting on, I'm going to give you from December 20th through the 31st. First of all, that entire period, the annualized return for that 12-day stretch over the last 32 years, annualized return of 77.09%. Small caps love December 20th through the end of the year. And you can see we're beginning it again. Now, Friday was the 20th, so we're really just starting kicking the gear. Here are the annualized returns from December 20th through the 31st. December 20th, 56%. The 21st, 121%. The 22nd, 70%. The 23rd, 104%. The 24th, 18%. The 26th, 182%. Annualized returns, by the way. I'm not suggesting that small caps are going to go up 182% on December 26th. Please don't misinterpret that. But on the 26th, I find this stat interesting. The Russell 2000 since 1987 has been up 17 times on December 26th. It's been down once. One time. That's this Thursday. But again, 26th, 182%, 27th, 25%, 28th, 24%, 29th, 64%, 30th, 88%, 31st, 109%. All positive every single day. The number throughout the year, the chances of the Russell 2000 since 1987, the chances of the Russell 2000 going up any particular day is about 55%. The Russell 2000 since 1987 has been up 4,466 days and down 3,650 days. So 55% chance. From December 20th to December 31st, that goes from 55% up to 66.5%. These are statistically relevant numbers. I mean, this is important. The market tends to go higher. You know, they call Santa Claus rally the week between, a lot of folks refer to it as the week between Christmas and New Year. I think that it really starts once you get past the middle of the month. I think it's just a 2-week long Santa Claus rally. All right, so those were some of the numbers I wanted to give you on the Russell 2000. I also wanted to point you to a blog article that I wrote almost 3 years ago. And the way you get to these there are archives. If you go in and click on my Trading Places blog or just the title, and you come in here and you've got all the articles going back in chronological order, starting with the most recent one I wrote just yesterday. Here you can click on blog archives. Now this one I just happen to know was back in January of 2017. But if you go back to January 2017, it was down around the 7th or 9th or 7th. So I wrote something, summary of sector relative strength by calendar month. And I really need to update this and publish another article because we now have 3 more years to consider. But it'll give you a place to start. If you go in here, what I've done is I've taken all of the sectors, all of the calendar months, and I've basically color-coded with average outperformance by each sector during each calendar month. So for instance, in January, and again, this was as of back in 2017, but January averaged, we saw technology average outperforming the S&P 500 by 1.2%. This doesn't mean technology goes up by 1.2%. It means that technology, the XLK, averages outperforming the S&P 500 by 1.2%. So I think that's pretty important. When you go down here, look at healthcare, 1.7%. So you can go back and look at this article, and it just kind of gives you a sense pretty quickly. The dark green is really strong outperformance. Light green is just outperformance, and then red is underperformance. So you can quickly, it's almost like a heat map to tell you what's strong and what's not by area of the market throughout the calendar year. I think that's pretty cool little spreadsheet. You probably want to need to upgrade. So having said that, let's go back here and now let's look at XLV from a seasonal perspective. So if we bring this back the last 20 years, you can see January, we average going up 1.1%. Pretty strong month. November and December have also been very strong months. And then the way you can tell and how I did that heat map on that spreadsheet is I compare it to the S&P 500. So let's do that. And let's go back 20 years. And you can see that healthcare outperforms the S&P 70% of Januaries over the last 20 years. So that's 14 of the last 20 years. And averages outperforming the S&P 500 by 1.4%. So on that heat map, that spreadsheet that I showed you, it showed 1.7. That's what it was as of January 2017. Now it's 1.4. That's still a lot of significant outperformance. And it really is the culmination of 3 really big months for healthcare. Now, if we go back here and we look at healthcare, look at what has happened. This is the seasonal time for healthcare. November, December, January. We broke out at the end of October, and November and December have been straight up. And it's one of the reasons why I continue to push for a lot of these healthcare areas, like the medical equipment, like biotechs. Pharma's now broken out. I mean, it's just all of these groups, healthcare providers. The weakest is medical supplies, and even that's not bad. Healthcare is something that you definitely want to be considering right now. Now, I showed you sketchers. I want to show you one other chart that I find fascinating in terms of performance in the first part of the year. So Booking Holdings, which was formerly Priceline, look over the last 20 years at these average returns first 4 months of the year. January 5.7%, February 7.8%, March 7.7%, and April 8.3%. These are average monthly returns for Booking over 20 years. Add them up. That's 12, 13.5, 20, 21.2, 29.5. Average return 29.5. Throw in May, and that would be 31.9. Average return for the 5 months. Now, of course, when you get into the second half of the year, it basically goes nowhere for 20 years. So looking at the chart, you've got, I don't know, since July, we were at 1900. Now we're just over 2000. It's basically been sideways. Now, last year we started off strong, but then we had the big gap down, rally back. We did have an up period for April, but it wasn't as strong as we saw previously. But what I would be watching here with Booking, watch for a breakout. Because again, if we get a breakout, we know what this stock historically has done from January to April. So if you make a breakout, I think that would be incredibly bullish. And we do have an uptrend in play here. I mean, I'm still seeing higher highs, sideways consolidation, higher high, consolidation. These lows are above these lows. I'm seeing higher highs and higher lows. Now, if I pull up a weekly chart, you can see we had downtrended for a while. And I think this looks to me like we're starting to uptrend. So if we're going to be bullish in 2020 and this stock makes a breakout, we know the seasonal tendency, this is a stock I would definitely consider. Okay, let's go to the 3 you must see to wrap up the show. Lennar, it's a home builder. Stock's been coming down here, as you can see, the past couple months. Look at the volume. Now, again, volume is kind of skewed a little bit from last week. But quad witching doesn't affect candlestick patterns. We have a downtrend and right here a bullish engulfing candle. I think we may have bottomed on Lennar on Friday. So off of this, I would expect to see a move back to the upside. And while you might look at these moving averages and say, well, are we going to get through? I think we're sideways consolidating. I actually think we have an uptrend, a left shoulder, neckline, a lower low to print ahead. I think we're going to run back up here to test this neckline, probably around 60, 60 and a half. Maybe one more pullback, and then I expect a breakout. But that could mark the bottom of the head, LEN. So I thought that was worth mentioning. Next up, CF. Now, in the specialty commodity area, first of all, just realize that this area has been very weak. And this was also the area that I focused on in the Earnings Beats Digest newsletter this morning. That's a newsletter that goes out 3 times a week, Monday, Wednesdays, and Fridays, which, by the way, it won't be going out this Wednesday, which is Christmas Day, or next Wednesday, which is New Year's Day. So not going to be sending it out those 2 days, but otherwise we will be on schedule throughout the holidays. But anyway, CX specialty commodities really struggling versus the S&P 500. Been doing so throughout 2019, but CF is beginning to show some strength, and we had a leader. The stock put in a 52-week relative high to its peers back in October before it pulled back, and now it's clearing this consolidation area on volume. I think it's got a really good shot to move back up in the low 50s and challenge these highs. So I think CF is one to watch here. And then the last one I want to mention, talked about it earlier, Interactive Corp IAC. I just really like this downtrend break with this volume coming in. Looks like the market has opened. We did open up a little bit here on IAC. But when I look back, I just see relative strength beginning to build. I like the internet group because it just made this breakout. I think internet will be strong. Watch IAC. I look for a move back up to test this overhead resistance, and then I think we're going to get the breakout. So that is it for today. Really appreciate all of your support throughout 2019, whether it's coming into the shows, reading the blogs, or certainly if you're members of the Earnings Beats community through the Earnings Beats Digest or even Market Vision 2020. Don't forget that's coming up. Make sure you sign up for that, or especially our paid members at Earnings Beats. That's why we can do what we do. So I want to thank everybody for a great 2019, especially all the support you gave me in August, September as I transitioned back from stock charts to Earnings Beats. We've gotten a lot of really good, positive response to the services and the products that we're offering now. If you haven't tried us, we would love to have you come on board. Go to earningsbeats.com and make sure you sign up. There is a $7 30-day trial. All right, everybody have a great holiday season. Merry Christmas to those of you celebrating. Happy Hanukkah. And of course, Happy New Year. And look forward to serving you in 2020. Everybody have a great end of your year. Happy trading today. See ya.